Welcome to The Explainer. Today, we are putting IP Strategy Holdings, that's ticker IPST, through a rigorous, completely impartial financial gauntlet. Why? Well, to figure out what is honestly a baffling market anomaly. This is a crazy story of extreme volatility, bizarre business pivots, and a total mathematical puzzle that's literally left people scratching their heads.
Right off the bat, let's talk about this massive number. Back in October 2025, this stock was trading at over $532 a share. And today, it's collapsed all the way down to roughly $2.20. I mean, that is a staggering 99.6% decline. So the absolute first question we have to ask ourselves here is this some once-in-a-lifetime buying opportunity where the market just completely mispriced things? Or, is the market actually spot on, pricing in a slow, painful march toward bankruptcy?
Quick note before we really start dissecting the data, this explainer is strictly an educational case study mapping out the source material's methodology. It's definitely not financial advice, and it's not a recommendation to buy or sell securities. Past performance, as always, doesn't guarantee future results. We're just looking at publicly available data to find the mathematical reality behind the chart.
All right, let's dive into Section 1. A bizarre business model. Distillery meets crypto validator.
To even begin to understand this collapse, we first have to look at their incredibly strange revenue split. So originally, this company was Heritage Distilling. They were a legacy craft distillery, selling vodka, gin, whiskey, rum, the usual. But then they made this radical pivot to become a crypto validator, staking tokens on the Story Protocol blockchain. Just look at this nearly perfect split in their $10.12 million revenue generation. We've got 51% from selling alcohol and 49% from crypto staking. It's kind of wild. It's so rare to see a public company operating as two completely equally weighted yet totally unrelated businesses.
And that brings us to what I think is the central mystery of the source's analysis. As part of this whole crypto pivot, IPST holds roughly $92 million worth of IP tokens right on its balance sheet. But here's the kicker. The total market cap of the entire company, it's hovering around just $1.6 million. Let that sink in for a second. The market is valuing the whole company at a mere 1.7% of its token holdings. So either the market is seeing some catastrophic flaw hiding behind the scenes, or this is literally an unprecedented discount.
Let's move on to Section 2, the valuation gauntlet, where we put 21 models to the test.
So let's run the actual math and push this company's financials through the gauntlet. By grouping these exhaustive valuation models together, a clear picture emerges. But honestly, it's not a pretty one. Standard cash flow and dividend formulas, they immediately break down to zero. They just can't function here. That basically leaves us with comparables and some volatile asset-based models, which suggest a weighted average intrinsic value of anywhere from just 50 cents to maybe $2 per share. And keep in mind, the stock is currently trading above that upper limit. Oh, and the real options valuation? It basically treats this whole operation like a highly uncertain lottery ticket tied to token prices.
The absolute crucial point driving those $0 valuations is right here. A trailing 12-month net loss of $201.77 million. The fundamental flaw that's completely breaking standard models, like your typical discounted cash flow, is that the company is burning cash at a rate 20 times greater than their actual revenue. Think about that. When you have negative free cash flow of over $15 million, the traditional math for finding intrinsic value simply stops working. It just hits a wall.
Next up is Section 3, the hidden flags, going beyond the media headlines.
When we dig deep into those SEC footnotes, we uncover this really fascinating, impartial tug-of-war between some super alarming risks and some genuine opportunities. Now, on the bear side, we've got 7 severe red flags buried in the filings. We're seeing major administrative distress signals, things like late SEC filings and a proposed reverse stock split. But for sure, the most terrifying metric for investors is this massive 23-35% share dilution. I mean, shares outstanding just exploded from 353,000 to over 8.6 million. That practically wiped out existing shareholders. On top of that, the return on invested capital, it completely cratered down to a dismal negative 167%.
But conversely, on the bull side, the green flags are legitimately compelling. First off, their crypto revenue grew from literally $0 to $4.95 million in just a single year, driving a total revenue growth of 57% in Q1. And even more impressive, that validator business operates on an incredibly high 95% gross margin. Add in $201 million in tax shields from past losses, authorized share buybacks, and actual insider buying, well, you start to see some real internal confidence that this whole bizarre pivot might actually have a very high margin future.
Moving right along to Section 4, the Legends Reality Check, featuring Graham, Lynch, and Buffett.
So to break this tie, let's ask ourselves, how would the greatest investors in history view this stock? Well, tracking through their famous frameworks, IPST systematically fails every single historical test. For Ben Graham, the father of value investing, the model fails because you just can't calculate a Graham number when you have negative earnings per share and negative working capital. For Peter Lynch, it fails thanks to an undefined price-to-earnings ratio and zero dividend. And Warren Buffett, it fails instantly for him too due to deeply negative owner's earnings and that severely deteriorating return on invested capital we talked about. Basically, the extreme negative earnings completely break the foundational math of all three legends.
Never buy a stock with a PE above the growth rate. This famous logic from Peter Lynch perfectly underscores exactly why these legends would simply walk away. You literally cannot calculate a sensible ratio when a company is actively destroying its own book value. To traditional value investors, this isn't investing at all. It's pure speculation.
Okay, Section 5, the economic moat and the final verdict.
Finally, looking beyond just the balance sheet, we have to ask, do they have the structural power to survive this cash burn? Morningstar defines 5 sources of an economic moat, right? Intangibles, switching costs, network effects, cost advantages, and efficient scale. And according to the analysis, IPST currently possesses absolutely none of them, 0. Their primary intangible asset is those IP tokens, but anyone can buy those on the open market. Their validator services? They have 0 switching costs, and they are completely commoditized. Plus, with only 21 employees, they completely lack efficient scale. They are truly exposed on all sides.
Impartially weighing everything from the source's findings, the reality of IPST boils down to a very binary high-risk bet. Look at the bear case. Token prices decline, the company runs out of its meager $92,000 in actual cash, they're forced into even more of that dilutive financing, and common shareholders are wiped out entirely. But then, look at the bull case. The IP tokens recover in price, that high-margin validator business scales rapidly, and they actually achieve profitability before the cash clock runs out, utilizing all those massive tax shields along the way.
So, knowing the model suggests the stock is actually overvalued at $2.20, yet it's trading at a microscopic fraction of its asset book value. What do you conclude? Do you see a misunderstood turnaround fueled by 95% crypto margins? Or is this just a massive mathematical value trap waving giant red flags? It is honestly an incredible case study in modern market anomalies. Thanks so much for joining me on this explainer, and I highly encourage you to keep questioning the numbers behind the headline.